Right. Warm greetings to you, colleagues. Welcome to our first lecture for FAC 3701 with Grad Consulting. So my name is Mr. Privilege. I'll be facilitating you, colleagues, with respect to FAC 3701 throughout the semester. So without any further ado, we're going to begin to indulge into the first topic of the module, which pertains to the concept on the conceptual framework for financial reporting. So now let's begin to unveil what you need to know from there. So now I'm going to take you through the lecture outline, which of course entails the learning objectives that one ought to have achieved by the end of this discussion. So the first point, knowledge or learning objective that you need to be able to have achieved is should be in a position where you're able to discuss the objective of general purpose financial. Just a moment. Apologies on that. I just wanted to close the door so that we don't disrupt the recording. Right. So the first learning objective or assumed knowledge that you need to achieve at the end of this particular topic, you need to be able to discuss the objective of general purpose financial reporting, as well as and the qualitative characteristics of useful financial information. You should also be in a position to identify the reporting entity and its reporting boundaries, right? And then, of course, apply the definitions, which is very key, number 3 now. Being in a position to apply definitions of the elements of financial statements, which entails assets, liability, equity, income, and expenses, especially in a given practical scenario. So you're going to find questions whereby they would give you a brief short case scenario, and from the basis of what they would have given in the scenario, they would want you to apply the definitions of either or rather of any of these elements of the financial statements to that particular case scenario. And then, of course, you give a conclusion as to whether the amount that is being stipulated in the case scenario perhaps meets up with the definition of an asset. And so if it does, it means then it will have to be, classified as an asset in the annual financial statements, or it can be a liability or any of the other elements to the financial statements as indicated here. Then number 4, you should be in a position where you are able to apply the criteria for including assets and liabilities in the financial statements. So that is basically the recognition process, right? And the guidance on when to remove them, which is the derecognition process in a given scenario. So you also have practical scenarios pertaining to assets and liabilities. One is where you show what we call the initial recognition of either an asset or a liability in the statement of financial position, to be exact, right? And so if it happens, for instance, that maybe the assets that you were owning have been disposed, meaning to say it has been sold out. So if you have sold that asset, well, you need to derecognize the presentation of such an asset in your annual financial statement. So the question would be, well, what process do you have to follow in order for the derecognition of that particular asset in your books should be? Same thing is true with the liability as well, right? So think of it in this way. With liabilities, that's debt that you're owing to your creditors, right? So obviously, upon fully settling the debt, it has to be derecognized out of our books. But of course, when we are obtaining debt from our creditor or maybe from a bank facility, we have to recognize a liability in our books. Question is, what procedures do we follow in recognizing a liability in our records? So obviously, yes, the ultimate part of it, when you're doing the recognition of such, it will be taking place in what we call the statement of financial position, particularly if it's of course, a long-term debt, then it will fall as a non-current liability. If it is a short-term debt, then of course it will be classified as a current liability, right? So you should be in a position to apply these principles in a practical case scenario. Right. So very important, I think, so far from the first outline of the assumed knowledge or the learning objectives, you need to be able to do this because this is what they would ask you in questions. You'll notice that at the end of the lecture, of course, it will not be today, but as we finish or conclude on this concept, which will be next week, when we conclude on this concept, I would show you practical examples, practical discussion questions where these principles will be applied in a real life case scenario. Right. But then our learning objectives proceed to the next page. And then the other one is you should be in a position to explain the measurement basis and their applicability in given scenarios. So when you're saying explain the measurement basis, there are different measurement bases of, for instance, measuring an asset when you are recognizing the value of an asset in your books. So most of the times, obviously, we normally recognize assets at carrying amounts, especially when we look at it in the financial statement. But of course, we would always, under normal circumstances, whenever we buy an asset, we will have the historical cost value of the asset. So all of that, we need to take them into consideration. But obviously, when you are presenting your assets under normal circumstances, especially property, plant, and equipment assets, which is, of course, the likes of land and buildings, machinery, equipment, vehicles, and all. Those ones would normally be presented at carrying value, right, in our records, right? And then, of course, be in a position to explain concepts and guidance on presentation and disclosure. So this now, of course, would be, dealing with how we, it will be dealing with where we present these elements of the financial statements in our books. So, for example, if we're talking of an asset, right, which book of which part of the annual financial statements would you see assets being presented? Will it be the statement of financial performance? So when I'm saying statement of financial performance here, I'm referring to the income statement as it was called before, or what we now call or recognize as the statement of profit or loss and other comprehensive income. So that's basically financial performance. Or is it the statement of financial position, which was commonly known as the balance sheet historically then? But of course, due to the changes in the IFRS standards, we now, of course, recognize the title, the balance sheet, as the statement of financial position. Right. Then, of course, so the rest of the other elements also, of course, they've got their own applicability. But the first three, which is assets, equity, and liabilities, we definitely see them being recognized in the statement of financial position in particular. Then, of course, with incomes and expenses, it will obviously be in the statement of profit or loss and other comprehensive income. Now, we've got other set of financial statements as well, but, for the interest of this discussion, we will normally deal with statement of financial position and then the statement of profit or loss and other comprehensive income. But you also see, of course, how it blends with the other financial statements. Now, you also should be in a position where you communicate clearly and concisely in a professional manner appropriate to the audience and the situation, right? So meaning to say now, when you're doing the presentation of these elements to the financial statements, how should you disclose them? Obviously, it will be contained within the annual financial statements of the organization. Now, these annual financial statements, they don't go in isolation. They are accompanied by what we call notes to the financial statements. So there are different notes to the financial statement that actually goes together with the annual financial statement. So for instance, we've got the property, plant, and equipment note. You've got your investment property note, trade and other receivables notes, trade and other payables notes, etc. There are several of them, of course, that you would see as we proceed, right? Then, of course, you should also be in a position to communicate, collaborate with others using a wide range of digital devices, technologies, and platforms, create teams and discussion. Now, this has to do much with what you'll be dealing with when you are on my UNISA. So it's not, content-based as in the sense of the accountancy as such, but it's just something that you know, it's more subjective as to what your lecturer expects you guys to do. So you must be participating in communication, like their communication platforms, which is mostly, you know, through the Teams discussion, or through the discussion forums, which is mostly, of course, on my UNISA platform. I'm pretty sure you are familiar with that, right? So, and then, of course, apply effective listening and discussion techniques to obtain and clarify relevant information. Of course, that is through my UNISA. When you go through announcements, always need to make sure that you're up to date with whatever that is being communicated with you guys pertaining to, you know, to the content of the module, right? But anyways, so the most important things, like which I've already pointed out, is this, to say from the first outline of the assumed knowledge, you must be in a position where you are able to apply the definitions of these elements to the financial statements, which is assets, liability, equity, income, and expenses. Then, of course, also being able to apply the criteria for these, for assets and liabilities, to be more precise. How do you recognize them when you're dealing with them when you're recording them in the books of the company? And then, of course, how you de-recognize them, for instance, in the case where the asset is no longer contained as an asset within the organization, or in a case where a liability has been fully settled, how do we, record those effects in our financial records? So my sister, that was to explain to you what you need to be able to have achieved at the end of this session. Point of reference with respect to these particular concepts, it's chapter number 2 of your textbook on gripping gap. So I used the 2022 version, but there's the most recent one, which is the 2024 version. So it's pretty much the same content. Nothing has really changed that much. It might be just some changes of some of the standards, the IFRS standards, but with regards to the conceptual framework, the last update there was, which I've picked up, is actually in 2018. So yeah, but from then up to now, there's nothing that has really changed. So you can still use this 2022 version, but the most recent version is the 2024 version, right? So this is just to show you the point of reference. Now let's begin to indulge into what this conceptual framework really is. What does it entail? How does it add value to me as a student with regards to understanding, the fraternity of financial accounting? Now, general purpose of the conceptual framework says CF, simply stands for conceptual framework, right? So what is the purpose of having a conceptual framework when we're looking at financial accounting? So number one, it is helpful. It is a helpful resource to the international accounting standards with regards to the development of the IFRS. So it helps in guiding, the international accounting standards boards when they're developing the IFRS. So they always ensure that the IFRS, which is the standards, obviously, of accounting, they are, drafted in alignment to the conceptual framework itself. So like any fraternity or profession, profession out there, there is a conceptual framework, or just, a standardized system or process that they follow when it comes to certain, procedures, or when it comes to how things are supposed to be done. So the same thing with accounting. There is, a certain framework that we as accountants ought to follow in the sense of, for instance, when the International Accounting Standard Boards are drafting or developing the IFRS standard, they always ensure that they are developing these standards in confinement or in alignment with the conceptual framework. And then, of course, the other general purpose of having a conceptual framework is to help preparers of financial statements to create their own accounting policies where necessary. I repeat again, it also helps the preparers of financial statements, which is obviously the accountants, to create their own accounting policies, right? And of course, this also involves finance managers, right? So it helps them to develop accounting policies. Now, with the policy, you need to understand this is an internal, it's an internal thing. So it's not something that, of course, is developed externally, because if it's an external, policy, under normal circumstances, comes, of course, in the form of an IFRS standard. But if it's something that we are generating and we are following and aligning from within the organization, it's obviously a policy. But those policies which are accounting in nature, we always ought to ensure that these policies are drafted in confinement to the conceptual framework. So that is another value that is obtained or purpose of having a conceptual framework. It also helps everyone, including the ISB, the preparers of financial statements, and the users themselves as well, to what? To understand and to interpret the IFRS standards accurately. So very important purposes or reasons as to why a conceptual framework is in existence. Number one, helpful resource to the ISB in developing this IFRS, and then of course it also helps developing of policies for the preparers of financial statements, and then of course it also helps several other parties, as you can see here, in understanding and interpreting the IFRS correctly, right? Very, very important. And then it also provides financial information about, okay, no, this is a different thing now. So the general purpose of the conceptual framework is these three items that I've already outlined to you. Now let's talk about the general purpose financial reporting. Okay. All right, just a sec. So what I was explaining was the general purpose of the conceptual framework itself. Three important objectives. They can just ask you that as a theory question. Then, of course, we have the general purpose financial reporting, itself. So what is the purpose of general financial reporting? Now, you need to understand there's a difference between a financial report and financial statements. You're going to see those distinctions as we progress, but there's a difference. So what we're trying to explain here is the purpose of financial reporting, which is, of course, what integrated reporting would entail. So, but anyways, one of the key reasons for, from an accounting perspective, one of the key reasons for general purpose financial reporting is to provide financial information about the reporting entity. So RE simply stands for reporting entity. That is to provide financial information about the reporting entity that is useful to the existing and potential investors, lenders, and other creditors, right, in making decisions relating to providing resources to the entity. Okay, let me explain what is going on there. So yes, there's financial information that we obtain from financial reports. This information is useful to certain group of individuals. Now, these individuals, we classify them as users of financial information or financial statements under normal circumstances. Like, for instance, if I look at an existing investor in a company, a potential investor in a company, these are people that want to put in their money as capital, or yes, as capital investment in the organization, in order for them to have a return on investment over a certain duration period of time. But they can only do that on the basis that the company they are investing their money in is profitable. How would they be able to know that where they are putting the money is actually a profitable return on investment? That is if, of course, they've got information that they would use in order to evaluate the performance of the organization. So existing and potential investors, that is their core interest when it comes to financial reporting. So these are users of financial information. What about in the context of a lender? A lender, obviously, it can be, for instance, the bank's financial facilities, right? So obviously, when a bank wants to give you money in form of a loan, they cannot just give you money in form of a loan, especially for a business, without assessing how your business is performing. So they need to have assurance that you are able to repay their money or their debt that they would have offered to you. So question is, how would they be able to evaluate whether or not you have got the ability to repay them? And the same thing is true with the creditors that you see there. So lenders and creditors and other creditors, these are really within the same umbrella. So obviously, for the lenders and other creditors here, they're interested in knowing whether your liquidity status is a positive one or not. They also need to know whether your business is solvent, meaning to say that it is expected that you've got, a certain amount of assets that exceeds the value of your total total liabilities in the business. That's solvency. But at the same time, when I look at liquidity and solvency, the two together, it also then couples into one thing that is going concern assumption of the business. So these people, lenders and other creditors, they're also interested in that to say, okay, what is the going concern assumption of this company? Are they able to continue operating in the near or foreseeable future before they can give you their money? Because otherwise, if they give you their money, but then there's no promise that you're able to pay them back, it's a loss to them. So, right. So that is just to explain why these parties, they're interested in the financial reports of a company. Now, let's talk about the limitation of the general purpose financial reporting. General purpose limitation, the limitations of general purpose financial reporting. So here's the limitations. It only provides financial information, and it is not designed for all the users, okay? It's not designed for all the users, not designed for all decisions, all right? Because obviously, for certain other parties in the company, those financial statements may not be as necessary to them. They might be interested in knowing, okay, what is the cash flow status of the company? They might also be maybe interested in the internal control systems of the company, the governance systems of the company, the internal control systems, the risk management systems of the company. So obviously that's internal audit. We are not as deeply concerned about the financial information of the company as such. Why? Because our focus area is different. So we need to be able to, so such a question you may get concerning this, it's a theory question really, where they might just want you to identify something. Maybe that is not a limitation of general purpose financial reporting, or maybe that is, a combination of limitations of general purpose financial reporting. You can get an MCQ question of that nature. So it only provides financial information. That's number one. Not designed for all the users, and it's not designed for all the decisions within the company. Not exact information could be presented to the users, and only provides historic information. When you look at financial statements, financial reports, just as a norm, you discover that, as a report, not a norm. When you look at financial reports, under normal circumstances, they give you information that is already transpired. So hence, we are saying it only provides historic information, but you're not given information, for instance, about what they are expecting or what they are anticipating to take place, for instance, in the near future or in the next financial period. You understand? So with financial statements, it's mostly historic information. So that is a limit, because somebody might be interested in knowing, okay, what is the foreseeable future looking like for you guys as a company? And then of course, it's not designed to show the entity's value. That's with the financial reports, right? Then of course, we've got what we call financial statements. Like I had explained earlier, there's a difference between financial reports and financial statements. A financial report, just so that you understand the distinction between the two, talking in the context of financial report and financial statements. So financial reports, it encompasses quite a number of items or quite a number of other reports within the organization. Hence, I mentioned about an integrated report, because an integrated report, it's a combination of reports about several aspects concerning a business. So when we look at the financial report of a company, we've got annual financial statements within it. We've got the auditor's report within it, the CEO's report, several other departments, accountable reports, contained in there, right? But with general, with the financial statements themselves, they've got a different perspective as compared to that of the financial report itself, which is the main thing. So financial statements, essentially, this is just part of your financial reports. All right, it forms part of the financial report, and it encompasses a variety number of financial information. So when you're looking at financial statements, here's what the financial statements conveys. Number one, only those economic resources that meet the definition of an asset, all right? And also it conveys information about only those claims which meet up with the definition of a liability or equity, and only those, it also conveys information about only those changes in resources and claims that meet the definition of incomes and expenses. All right, let me explain what is going on there so that you understand. So essentially what this means is, when you look at financial statements, all right, we will see information, especially to be more exact, in the statement of financial position, you will see information about assets, you will see information about liabilities, you will see information concerning equity. Then, of course, when you go to the statement of profit or loss and other comprehensive income, you will see information regarding to incomes and expenses. So essentially, that is just to say, when you look at your annual financial statements, what you see being presented there is the elements of financial statements. And each element of financial statement, it has got a certain significance, that it portrays. So when you look at, instance, assets, okay, assets, obviously, these are economic resources that the organization controls, of which they would expect to derive some economic benefits from them, as a result of past events. Okay, so what I'm trying to give you already there, I'm just introducing you to the definition of what an asset really is. Why am I saying this? Because you get questions, colleagues, whereby you would be asked to evaluate a specific amount given in a particular case study scenario, and you need to then evaluate, the value or the amount they've given you in the scenario based on those elements of the definition of an asset, for example, before you get to the conclusion. And it can be a question of like 6 marks. It can be a question of like sometimes 10 marks, depending on what they've asked you to do, right? So you need to be in that position where you are able to explain those things, but explaining them with understanding of what is going on, right? And then with liabilities, these are claims, right? These are claims against the company, all right? And then, of course, equity as well. But then with equity, it's not a claim against the company. This is what we put in order to start the operations of a company. Then, of course, you've got changes in resources and claims. So when there's changes in our assets, for example, which would obviously happen when we depreciate our assets, all right? And then, of course, also changes in claims, for instance, when we are repaying our liabilities and all of that, or when we are running the business operations, okay, it will result effectively in the changes in resources. It will result effectively in the changes in the claims. We need to say changes in the liabilities. So those changes that will be taking place, we account for them as incomes and expenses in the statement of profit or loss and other comprehensive income. All right, so what's going to happen? We're going to have part B just now. So we're going to reconnect for part B of our lecture 1 discussion. So you connect immediately just as soon as this meeting cuts. So you reconnect again and then we'll be proceeding. Because it's going to cut us